great honor now to introduce our last keynote of the day. And I've had the pleasure of interviewing him earlier today, so I know you are all in for a very nice treat. Gold going forward, follow the direction, not the lies. A lot has happened in the last 6 months, and Matthew's a returning guest, Matthew Piepenburg. He's a partner at Greyerz Gold, and I think it's your 3rd time presenting here. So we must be doing something right that you're coming back, and we do tremendously appreciate it, Matthew. Really looking forward to getting an update. Where are things headed? What are the lies I asked you in the interview? What should we be paying attention to? And what's the outlook? What are we going to do? Matthew, thank you so much for joining us again. It is so much appreciated. Thank you. Oh, there was a step over there.
Oh, there was. All right. Sorry. All right. Well, I know the audience is here to really talk about mining and precious metals. In that regard, I'm here to talk about the price of gold, which still matters because the spot price and the production costs in mining matters. So looking at the direction of gold matters as well. So hopefully this will have some value than just another lecture on why gold. You know, as Kai indicated, I'm a partner, director at Von Greyerz. We're the largest private gold provider for high net worth clients in the world outside of the commercial banking system, and we have clients in 90 countries. We look at gold very seriously. Real 20-second background on me. I'm a German-American who lives in France, educated in the US and Germany, a French wife, French kids, and an office in Zurich. So my perspective on the world is a little bit cynical, silly, disciplined, depending on which culture influences me the most. But while I was in the US, I was a hedge fund manager during the dot-com bubble, was a lottery ticket winner on a pre-IPO, completely naive and lucky, and yet because of that high-class problem, I became a family office CIO and director, and I moved almost exclusively for years in risk assets and hedge fund allocations and private equity and VC, everything but precious metals. And then I discovered precious metals and gold because I was interested in wealth preservation rather than wealth speculation. And in short, I changed from risk assets, not for any reason that you would have to, but my personal situation, I changed because, as Mr. Chambers was talking this morning, or this afternoon, Clem was saying, I saw a new direction, and that direction is gold, and I'm going to talk about why the direction is very important. It will start, with a kind of an annoying metaphor. Everyone knows hockey, Wayne Gretzky, the secret to success in hockey is playing where the puck goes, not where the puck lies. In my case, I'm a polo player for 30 years. I know everyone hates polo players. So do I, frankly. I tend to prefer the horses more than the players. I get it, so don't roll your eyes. But I'll tell you, the analogy in polo is very true. If you're going 30 miles an hour down a 300 yards field and you see someone about to make a backswing, the direction of that ball changes immediately. And suddenly, instead of going straight, you're turning 180 degrees the other direction. And you see that backswing coming with the rotation of the wrist, near side, offside. The point is, you have to make your turn before the ball is struck or before the puck goes in that direction. You have to play the direction. And to Mr. Chambers' point as well, that direction isn't just short and sweet. It's a long-term direction in gold. I have almost too much conviction about that. That's what concerns me. But when I look at gold, it's not at all for speculation, although I think there's massive price optionality because I think the price is going in a secular direction. It's, for me, a preservation asset. It's to stay rich, not to get rich. But the gold price is important, and we'll talk about it. But gold really addresses 4 risk themes that we can't get into. Each one of these we could spend an hour on, each of these silos or verticals. Obviously, political risk. You don't need me to talk about geopolitical risk. It's certainly between the Trump election and what's happened here in the German coalition, that's interesting. What's happening with Trudeau's coalition in Canada, for those of you coming all the way from Canada. Certainly in the UK, Labour and Tories, there's been a huge shift. Really, no one's talking about debt, whether it's Labour or Tory, Democrat or Republican, left or right. And we've also got massive geopolitical risk, whether it's missiles heading to the Ukraine. Gosh knows which Hamas leader is in charge today and what happens in the Middle East. I'm not here to give an opinion on the Ukraine or on Israel. I'm certainly not going to predict everything that can happen, but the escalation in political risk is enormous. Banking risk, again, spend all day on banking risk. I talk to a lot of bankers. I have a lot of clients who are bankers. We just saw in my country in 2023 three of the 4 largest bank failures in our history, and yet it's already off the headlines, ignored, forgotten, aus den Augen, aus den Sinn. The capital to assets number, which is more important than risk-weighted capital, is appalling on American banks and frankly Chinese and European banks as well. In terms of currencies, central banks are at a race to the bottom to lower rates, to debase their currency, to monetize their debt. We'll talk a little bit about currencies, but again, you could spend 45 minutes on currency risk. And then there's the markets. Again, I came from a risk asset background. I've seen bubbles. I've seen overvaluation. I'm not speaking just as a gold bug to be critical about grossly overvalued markets, but Ray Dalio sees this, Druckenmüller sees this, Paul Tudor Jones sees this, Jeremy Grantham, who I invest with as a hedge fund manager, sees this, has been seeing it for years. So it's not a gold bug cynicism just to say the end of the world's coming, bubbles are going to pop, and the whole thing mean reverts. But we have to keep in mind that the S&P's market cap, 20% is driven by 3 names, and the NASDAQ, 50% is driven by 10 names. That's an extremely narrow market. The S&P trades at 7 times the global equities index, so 7 times global stocks. You don't need to be a market analyst or Goldman Sachs, young new Turk, or an analyst of financial sectors to see how grossly overvalued this market is. It doesn't mean it can't go higher. In fact, structurally, based on momentum and certain volume things that I track, just because I can't help myself, I actually see this market going higher before it does what Bob Farrell promised: all markets mean revert. Don't forget the importance of these legends like Bob Farrell, or the madness of crowds like Charlie Mackay, and probably most importantly, Ben Graham, that you still need to find value. These things are forgotten when we're caught in the euphoria of the nonsense that passes for price discovery in the S&P, the DAX, the Dow, and the NASDAQ. But again, by price to book, price to sales, price to earnings, these markets are crazy. You will never pick the top. You will never pick the bottom. You just need to know when a top is coming. We can talk about some signals about that, but you're not really here to talk about risk assets. I'm just saying that it's important that these are all major risks that gold addresses. Again, that's me, the polo player, the handsome guy on the right. And again, what have I learned? As again, Clem Chambers' father told him, it's really simple. Just see the direction, know the direction. Don't speculate or guess or hope on the direction. I've spent many, many years trying to understand gold to the point now where I said I'm worried because I have so much conviction. And sadly, the reason I have so much conviction is because of the stupidity I see at central banks, in the State Department, in the White House, in the Parliament, in the National Assembly, et cetera. Never underestimate the stupidity of public officials or experts. That may be the cynical French influence or the immature American influence in my biography, but there's no denying that there are massive risks facing the world, military, energy, et cetera, that have a direct influence on the gold price. It does not mean the gold price moves in a straight line, but the direction to me is almost too obvious. Now, again, I look at the direction of the ball. That's what gets you a higher handicap in polo, or make oxymoron. That's like trying to swim with a cannonball tied to your neck. Eventually, you have to pay that debt. So 3% GDP growth is actually a fiction. It's a lie. Now, when you look at markets ripping, though, markets are ripping. There's a big difference between my little stock market, or my big stock market, and the Main Street that I grew up on in the Midwest. There's a massive difference between Wall Street and Palm Beach and Park Avenue and Madison Avenue, where I just spent a week and a half going from the Loudoun County polo fields of Virginia and all those defense contractors and all those Wall Street superheroes and all their second homes up in Maine and Massachusetts and Pennsylvania, Michigan, Ohio, Minnesota, where the real America, what Walt Whitman described, the base of any great country, are suffering. It was amazing. In D.C. and New York, nobody thought Trump had a chance. He's too crazy. I understand that. But then you go where people are struggling. When you stand in the rain long enough, you'll get in anyone's car. You go into Minnesota, you go into Pennsylvania, you go into Michigan, where people are suffering 22% interest rates on their credit cards, their cars are being repossessed, they can't pay tuition for their kids. Of course, they'll vote for anybody. And they just did. It wasn't a surprise to me. It wasn't a surprise at all. They want someone who's not political. They want someone who's not part of that swamp. Rightly or wrongly, they chose Trump. Now, markets, meanwhile, are ripping. So that must mean the economy is ripping. But again, it's only ripping for the top 10% that own 80% of the stock market valuations. Again, never good for all of us when there's so much wealth inequality and disparity. Now, the market ball direction is a really fascinating thing for me. And again, I come from a risk asset background. I did manage a hedge fund during a bubble. I was lucky to get out in time. I wouldn't say I was a genius, but after I had made a lottery ticket win in that market, which is basically like a Bitcoin trade at the time, I was making huge multiples on penny stocks that were trading for hundreds of dollars, I had to become educated in risk assets. I had to look at them. And again, by every metric, including the most obvious, the Buffett indicator, which is at all-time highs now, which is worse than the dot-com bubble, worse than 2008. By every metric, again, the S&P and the Dow and the NASDAQ are grossly overvalued. Look at NVIDIA. $2 trillion of its $3 trillion market cap happened in 2024. Now, this is incredible. I remember when I was a little fancy lad, hedge fund guy in New York City in the late 90s, I remember trading Cisco, NVIDIA, Qualcomm. Cisco got to $550 billion. We thought that was extraordinary. You know, I was in a stock that I got pre-IPO called Commerce One, went from pennies to hundreds of dollars. By the way, by April of 2000, it was worth zero. Things can go from the sublime to ridiculous when you don't know what's going on. You're just speculating. Cisco is not a bad company. NVIDIA is not a bad company. Amazon's not a bad company. Lucent, Qualcomm, not bad companies, grossly overvalued. And if you want some free advice on when to short a market like that, look at the net income margins. Do your homework. Look at the net income margins on all these tech super kids because, you know, they have huge advantages on cost, price, and volume. When net income is rising, you don't want to short that market. When it starts to stall, you don't want to short that market. But when you start to see it go significantly down, that's when you can make your most money on the big shorts because markets fall faster than they rise. You just got to look at the data, just like with mining. You don't just follow an index, do your homework so you have knowledge, not speculation. But the market ball, and this is a market ball, and I do believe markets do things like mean revert. I still think that law of physics in the markets still exists. We don't see it right now. But the market ball is deeply tied to the inflation ball. And we can talk about inflation, about supply shocks, China, tariffs, all kinds of interesting things from the experts. To me, it's pretty simple. When the global money supply increases by 5x in 20 years, M2, that's the Milton Friedman definition of inflation, the grotesque expansion of the broad money supply. We monetize debt with mouse-click money. It's a wonderful, magical solution. It works for a while until it doesn't. Don't ask me to time it, but it's simply, to me, a fantasy that has lasted longer in America than I would have expected. But like Paul Tudor Jones, who I know from Virginia, all roads do lead to inflation because all roads lead to monetizing our debt with money mouse-clicked out of thin air at the Eccles building or at the Bundesbank, et cetera. 800 PhDs at the Fed, the FOMC, got temporary inflation or foiloific inflation. They got that 100% wrong. Now Powell wants to be Volcker. That's absolutely comical. When Volcker was the Fed chairman, our U.S. public debt was $500 billion, not $36 trillion. Volcker could raise rates to fight inflation. Powell simply cannot raise rates in the backdrop of $36 trillion in debt because we can't afford our own interest expenses to pay that debt. And the only way we could is to mouse-click more money. So then our war against inflation is inherently inflationary. We are in a trap now, and no one wants our IOUs as well. China and Japan, big buyers, and other central banks aren't buying U.S. treasuries. If no one else is buying them, someone or something has to buy them. And I'm sorry not to be so simple, but that is going to be a central bank near you, and that is an inherently inflationary reaction people talk about, and it gets wonky about whether QE is inflationary. Again, it takes an hour to unpack that. Yes, of course it's inflationary. I live near Bordeaux. If I have a wonderful bottle of red and I pour buckets of water into that glass, that dilutes the flavor of the Bordeaux. You cannot add buckets of liquidity to a currency without destroying its punch, its pack, its taste, its geschmack. It's simply simple common sense. So to me, we're monetizing with mouse-click money. We have to inflate or die, or as Larry Lepard said, you cannot taper a Ponzi scheme. Again, I'm simplifying for the interest of time, but what central banks have done, what modern monetary theory is ultimately a high-class Ponzi scheme with the power of the world reserve currency behind it and all the other countries of the world tagging along. But it is a Ponzi scheme, and you can't taper, not without massive ramifications. So the inflation ball and the currency ball also move together. This is a simple graph. Sometimes simple, stupid is all you need to know. This is the euro, the dollar, and the British pound sterling. Since the wonderful Nixon decided to get reelected, he needed more money to do so because he was looking down the barrel of a very dark economy as he was heading into a pre-Watergate election. Like every politician, he wanted to buy votes, buy good times. He needed more cash. The gold standard kept him from being able to create more cash. So what did he do? He just jettisoned the gold standard in 1971. Over 50 years ago, he said, by the way, that would be temporary, 50 years ago. And he also promised that it would have no effect on the purchasing power of your dollar. Again, two open lies at the time, not just in retrospect, but now the purchasing power of the dollar since 1971, when measured against the milligram of gold, has lost 98% of its purchasing power. The other major G7 currencies are no different. This, again, is almost as simple of a ball direction as there is to look at. But again, just the currency risk and what debt has done, what monetizing that debt has done. People talk about gold in 2024 as going through a bull market. It's not. It's just that fiat paper money is going through a bear market and going to continue to go through a bear market. And regardless of the daily, quarterly, or monthly, or even annual direction of the gold price, I have no doubt that politicians around the world will continue to base their money to buy votes and time until they can find an excuse or a war to blame their currency crisis on. So knowing that, it's just, I know paper money gets increasingly useless, and therefore gold will become increasingly relevant. So currency and debt cancers lead to political and social unrest. We all know about geopolitical stress right now. Again, Mr. Chambers was talking about tensions with war. He sees no end in sight. I agree with him on that. There are obvious headlines today. I won't get into my opinion on whether Zelensky is George Washington 2.0 or whether Putin is really Adolf Hitler, because every bad guy is a Hitler. It's either Trump or Putin or somebody else. That's an insult to what people have suffered under Hitler. I don't think you can make those comparisons lightly. But yet, here we are. Israel, Hamas. How many leaders in Hamas? I don't know which the latest leader. I wouldn't want to be in his shoes, but that's another crisis for which I don't have a specific opinion or answer for, but it's clearly a problem. South China Sea, and more American bases are floating around Chinese borders. That red line, as Mr. Chambers said, is getting fatter and fatter. We're playing brinksmanship in a nuclear era. It's absolute madness, but that's where we are. But let's talk about something that I will talk about with bias, prejudice, and perspective. My country and the oil price and the oil energy, and energy is power. Energy explains U.S. foreign policy since Vietnam, and certainly since Iraq, Libya, Syria. Heck, we're allies with Saudi Arabia, a country named after a family. What does Saudi Arabia have to do with democracy? We don't care. We don't care about Operation Freedom in Iraq either. We do care about oil and energy. It is where power lies. You can be green all you want. It's going to be many, many years till the world's carbon neutral. Oil is still power. The U.S. knows it. Russia knows it. China knows it. Saudi Arabia knows it. So oil is a base layer motive for foreign policy and for financial policy, for foreign wars and for financial wars. China is the world's greatest oil importer, and they've been exploding in that thirst for oil since we let them into the WTO and sent the American dream to be made in China. But I'll tell you, China wants and needs a non-US dollar oil solution. And Kyle Bass saw this years ago. We definitely, if I were in China's shoes, would not want to be the dog wagged by the U.S. tail and the U.S. dollar when it comes to purchasing oil. China is desperately looking for oil, and they're desperately looking for a way to buy it without having to hold U.S. treasuries. Enter 2022, we freeze Putin's assets. Real short-sighted, brilliant move, in my opinion. Very stupid. I'm being sarcastic. What does China and Russia do? Well, it's very simple. Russia has a lot of oil to sell. China has a lot of oil to buy. Now they're selling oil to Russia, to China, and China's paying for that in yuan. And Russia's taking that yuan, no problem. I'll use your yuan to buy a lot of your products. By the way, they used to be made in America. And any delta or difference, I'll net settle in gold on the Shanghai exchange. So you're seeing gold become an energy supply or an energy buyer. That's not a surprise. You're seeing other countries doing the same thing. You're seeing Saudi Arabia and the UAE joining the BRICS. That is a ball direction. That is a puck direction, folks. That's not a coincidence. That's not because they're angry at Biden. It's because they are slowly but surely, not overnight, finding ways to sell oil outside of the petrodollar. By the way, when you're President Biden, you can't call MBS a pariah and expect to have good terms down the road. You got to think a little longer term. You can't have a weak dollar or a weak U.S. Treasury or too much debt, because that makes the oil price volatile. Again, it's not the end of the petrodollar. It's not even the end of the U.S. dollar. It's simply a repricing of that dollar, and it's a change, slow but steady directional movement of the pole. Now, the BRICS know that gold is a reserve asset which holds its value in energy terms. Gold simply buys more oil than dollars do. But then there's the gold ball itself. And I've got 2 minutes, so I'll make this quick. We grossly underestimated 2022 and that chest-puffing American, proud America. We're going to bully the world. We're going to freeze Russian assets. By the way, if I have an account at Dresdner Bank and they freeze my assets, I'm not going to recommend Dresdner Bank to anybody in this room. No matter what you say, that genie doesn't go back in the bottle. You can freeze assets against Iran and Venezuela. You can't do that with a country that's a nuclear power like Russia, with its natural resources already embedded with the other BRICS nations, without consequences. As usual, American foreign policy is myopic and still thinks they're the America of 1945, which they're not. The People's Bank of China, Saudi Arabia, the central banks are buying gold at record levels. China bought 1,600 tons post-COVID. It mines 370 tons annually. The GCC, the Gulf Cooperation Council, the oil-producing states are importing gold from my workplace in Switzerland. We see it every day. And the 2014 graph on the right makes it very clear. This is the direction of the hockey puck, folks. Central banks are dumping U.S. treasuries and stacking gold. They've been doing it since 2014, and no one's talking about it. You don't and should not have to be a gold bug to know why. And the reason is very simple. The world wants to save in gold and spend in fiat. They don't trust the IOUs, the sovereign bonds of a grossly indebted country like the U.S. or, frankly, Europe. And again, gold is at all-time highs, even despite 2% positive interest rates. This was once thought unthinkable. Gold supposedly hates a strong dollar, rising rates, and disinflation. But even though we had all of those things, gold hit all-time highs. Why? Again, because the world doesn't hate the U.S. dollar, isn't abandoning the U.S. dollar, isn't going to leave it. We need it for liquidity. It's simply repricing it, and it's saving, like the central banks of the East, in gold rather than U.S. treasuries and U.S. dollars. And finally, I've got a real quick, is gold too expensive? Well, it's up since 1980. It's up 230%. The S&P's up over 5,000%. U.S. federal debt's up over 5,000%. And yet we're complaining that gold might be too high. Frankly, it'd have to go up another 20% this year just in an inflation-adjusted way to be as expensive as it was in 1980. And when you adjust for M2 money supply, gold is as cheap now as it was in the 70s. So no, gold is not overpriced. You know, when gold goes to 10,000, the cost of a loaf of bread is going to be a lot higher too. I'm not saying this as a gold bug. I'm not saying this to you become a client at Von Greyerz. We're boring. We're not sexy. We're not into speculation. We're about staying rich, not getting rich. And, but I am saying it does matter the gold price for you that are looking at miners because, again, that spread between spot and production matters. The direction, as Mr. Chambers said, is knowing. And I'm almost embarrassed how much hubris I have, how much I know the gold price is going to go up. It does not mean in a straight line. It doesn't mean there couldn't be a tracement. Tomorrow, Henrik's going to talk about what happened in 2008 and gold losing 30% when the markets crashed. I don't think 2024, 2025, where I do foresee a market mean reversion, I don't think that means that the gold price is going to retrace. It's a very different world today than it was in 2008. I wish I had time for more questions. You can maybe catch me outside. A lot to pack in, but that's my view on gold, and thanks a lot for your time.